We are back with another episode of the Real Estate Investing Club. I hope you guys are having a great day. As always, we're bringing you that Friday energy. And it's a good day for a second reason because we got Pete Neubig with us on the show from VPN Solutions. Pete has a lot of experience in pretty much anything you can think of. Pete's done it single family, multifamily. He started his own property management company, and now he has a virtual assistant company, still doing investments in single family. So I'm sure there is a really great story in there, and I'm excited to hear it. Pete, thank you very much for hopping on the show.
Gabe, thanks so much for having me. Looking forward to it.
Absolutely. Speaking of stories, I told you before we got on here, we always like starting with stories. We'd like to hear how you got to where you are. So why don't you take us to the beginning of your experience in real estate and tell us how you got here?
Yeah, so I was about 30 years old at the time, and I had been working for, 10 plus years already. I was an IT guy, and I was taught, hey, go to college. Uh, you're taught go to a good school. I went to a school. You're taught get a good job. I got a job. Right?
Fair enough.
And so I was feeling at the point like I think 30 was kind of like my midlife crisis because I'm 50 now and I haven't had a second one, but I'm like there's got to be something more than just going in and trading your time for a dime. And I go to my wife and I'm like every time I go in that office, a piece of me just flex off. And I'm sorry, I wasn't actually married at the time. What happened was I wanted to start my own business, but I didn't know how. Like I never did business before. So I'm like, oh, I can go buy real estate. And so that's how I got into real estate. So I'm like, it was just for me, it just seemed to make a lot of sense, right? You buy something at X, your interest rate is Y, you rent it at Z, and then you have NOI. And then if you increase the NOI, you can increase the value of the property. So I started mine. My first deal was a duplex, and the same day I closed on a duplex and a 100 unit apartment complex. Those were my first deals. The hundred
A
unit
two
was a
unit and a 100 unit. All
two
right.
unit, 100 unit. So the 2 unit, of course, I own that. I bought that myself. The 100 unit, I was a passive investor,
Mm.
and so those are the first two properties I bought. And then over time, I bought a bunch of duplexes. I got into a couple other apartment complexes. And then what happened was I bought 31 single family homes with a business partner, and we bought a
Oh,
whole
wow.
bunch of properties. I kind of traded into duplexes. Instead of going from duplex to fourplex, I went duplex to single family. And we bought a whole bunch, and we bought them too quick, bought them like like within 2 year time frame. And we loved buying them, but we didn't love putting residents in, doing the maintenance, doing the make readies,
The
managing them,
deal is the
collecting
exciting
rent.
part. The managing is the tough part.
That's right. That's right. And so we look for management companies, and this is kind of in the infancy of internet. So it's like 2006, 7, 8, around there. So we decided, you know what, we can build a better mousetrap. So I'll be honest with you, Gabe. I thought I created the single family property management industry but then I found out about a year later that there's thousands of people that do this. I just didn't know about them. But the funny thing is, we found that the management firm, we ended up managing for other people that were in our circle. And we managed about 67 doors. We owned 31 of them. My 31 properties were losing money, but the management company actually made money. And I'm like, huh. So I'm like, wait, maybe we should just do this management thing for third party management. So we built that company from, I think it was like 2011 to like 19. We built that company. We sold it in 19. But I was so busy building a company and so busy managing other people's properties. I ended up selling a bunch of my dogs, if you will. Like they weren't appreciating, they weren't cash flowing. They were just tough properties to manage and to turn a profit on them. And so we sold all of those, ran the management company for about 8, 9 years, sold that. And the day I sold that management company, I bought six more properties. So I paused for like 8 or 9 years, and then I bought more properties, which is crazy because now when I think about it, all the deals that came across my desk now it's too busy to jump on them is just it just burns me, because I'm like I could have because when you're the management company, you know everything about the property, right? I
Mm-hmm.
know how much maintenance, I know if it rents well, I know if it rents for the price that we think it's going to rent for, I know if it's in a flood zone, I know the history of the property, and typically when people want to get out of properties, you can get a deal because they're rented, so they can't get the retail. They can only get another investor, and I could have made it easy for them. And that's how about the last six. On my way out, I found a couple of investors looking to offload some of their properties. I got a deal. The nice one was the last one. I bought a four in a four pack. I bought them for 535 and they appraised at 650
There
when
you
I
go.
that was a nice deal. And I still own those properties today. Now they're even
Yeah,
worth
way
more.
much. Yeah.
Yep. And so that's kind of the story in a nutshell.
Ups
Other
and downs, lefts and
lots of ups and
rights.
downs in that deal. Yeah.
Yeah. I mean, I hear you like taking a step away from investing, seeing all those deals pass you by. I'm sure you got frustrated after a time, but having the experience of being the property manager running a property management company, I'm sure that gives you a lot of perspective, a lot of experience that informs your current deals. Because people, I mean, I've said this so many times on this podcast, finding a good property management company is one of the most difficult um, pieces of the puzzle for any deal. Making sure that it's managed well, that the person who is managing it knows what they're doing, all that kind of stuff. So I'm sure you having that experience informs what you do today.
Well, not just that. Because I was big into the property management industry, I got to meet property managers from all over the country.
Mm,
We have all these, we have these two conferences. We get to meet people. So if you're looking for a good property manager, you should go to narpm.org or narpm.org for single family. Those are the people who are professional property managers and they treat it like a business. A lot of times you get a realtor, they do property management kind of on the side,
mm,
and they don't keep up with legislation, they don't keep up with just technology, things of that nature. So today when I buy, I don't buy in Houston anymore. So I live in Houston, Texas, and I think seven or eight of my houses are here in Houston. The last house I bought was in Tulsa, Oklahoma,
oh,
and
okay.
so I'm looking in different markets now. And I have a couple of property managers, one in Tulsa. I got one in uh, Indiana,
Mm,
Indianapolis area, and I'm looking at maybe buying there next. So a lot of what I do now is I lean on my property managers or my property management friends to let me know if it's a good deal because they know the market better. And I built that trust with them over years. But
yeah,
if you are using property managers, you should leverage them to find good deals because a lot of times they'll get a deal come through, they can't even take advantage of it, and they don't even send it out to their clients. But if they know you're looking, a good property manager will send those deals your way.
for sure. So if you let's go back to the you who had just bought those 31 units back in the day, and you were looking at starting your own property management company. If you were back in those shoes, would you do it again? Would you suggest somebody who has a portfolio start their own property management company, or would you tell them focus 100% on finding deals, buying deals, and flipping deals, and don't hire somebody else to do the management?
Yeah, I got lots of nuggets here. Okay, so the first one is don't buy Class D properties.
Mm-hmm.
Like that's the first one. Or if you're gonna buy Class D, like I was buying, so my investment strategy back then was I put everything in an Excel spreadsheet and I looked at the bottom right, and the bottom right said this is your cash flow, this is your expected cash flow, and I was only buying on cash flow. I wasn't looking at appreciation, depreciation. I didn't look at principal pay down. I wasn't looking at all five legs of the stool. I was like a sniper, only looking at cash flow, and I missed the boat. We bought in a really low income area, and we were buying houses for back then. This is in 2005 to 2008, around there. I was buying for $35,000, right? And all I saw was 10% down on these houses, or 20% down is almost nothing. They were renting for 800. My note was like 200, and you're looking at $600 in cash flow.
Mm,
Of course, taxes are cheap because it's in the low area. And so you're looking at, oh my God, I could buy 600. I could get $600 in cash flow for every property. I'm going to buy 50 properties, 600 times 50. I could leave my job. Kind of what I was thinking. And then there was another area of town. I bought one house for $78,000. The house we're going for 100. So I should have bought them for 100, but I bought this one for 78. It's the one I actually live in today. I actually took it down and it's worth over 1.2 million. If I would have bought 10 houses at the 100,000, the challenge, the reason why I did not was because they were only renting for $1,000. So, or less than 1,000. Sorry, they were renting for about 900 bucks. So I wasn't getting at what's called the 1% rule.
Mm,
And so I'm looking at my cash flow on $100,000 house was going to be break even, maybe even cash negative. But on these other properties, they were going to be cash positive. Well, if I would have looked at everything, because it was pretty like I knew when I bought this property, I was going to live here one day. I didn't move here until I bought this house in 2005. I didn't knock it down and build until 2017. But knowing that I knew that I was going to live here one day because I knew it was going to be an up and coming area because I saw other little houses getting knocked down already in 2005. And so I innately knew that if I would have just bought the 10 houses here in this area, I would have been a multimillionaire instead of buying 30 something homes and, just having chaos and not making a dime.
mm,
And so I think rule number one is, if you really, if you kind of, if the market's kind of, your gut says, hey, this is the right market for you, buy it. Number two, don't just look at one aspect of investing. If you're just looking at cash flow, right? And Kiyosaki made it famous, like with his book, and everybody wants cash flow, but you make the real money on the appreciation. So the second thing I learned is even though you have to treat real estate investing like a business, it's not a business. The business is your ATM machine, which gives you the money to buy the properties. The properties are not a cash machine. They're not a cash flow machine. What they are is their wealth building machine. So you buy and hold, it appreciates, you have the principal pay down, and if you get some cash flow, even better. And that's wealth building. So you buy the properties now, 20, 30 years, they're all paid for, they double, triple in price, whatever it is, you give them to your kids, your grandkids. I learned, that was the other another piece of advice I give or something that I learned back then. And the last thing is if you are an investor, do not learn how to, and you don't want to learn how to change out a toilet, right? You don't want to become a maintenance guy. You also don't want to have to like learn how to like collect rent and learn how to do property accounting and like there is like people think that property managers all they do is collect rent, and that is like 1/1000th of what they do, and they do a lot of stuff for free. And so if you're an investor, I would stay as an investor and manage the property management company, hire a management firm, and don't worry about what they charge. Worry about what results you can get from them, and then utilize them to find more deals and keep and learn better negotiating skills. Learn how to learn how to get more deals. Learn the ways that's going to make you more money. Because I promise you, managing your own properties. What happened to me is I couldn't buy anymore because I couldn't buy any more properties because I was managing them all the time. And I think that number's around 8 or 9, right? Once you buy 8 or 9 single family homes, next thing you know, or a 30 unit apartment complex, next thing you know, you are spending all your time dealing with maintenance requests and move outs and evictions and tenant requests and property accounting. And next thing you know, you get too busy and you never mind another property and you never get to the wealth building that you wanted to, right? We all have a number in our head. We all have a goal. And once you buy those properties, if somebody's not managing them, typically you're short on the goal.
yeah. Yeah. No, that you couldn't say it any better myself. It is so difficult, I feel like, especially in the beginning, to see the long-term goal when what you need is cash flow. And so when you go and you're looking, you want to be an investor, but you need money coming in. And so all you're looking at is cash flow. And that's when you start looking at those D-class properties. And that is that it's a difficult thing to kind of
Gabe, there's nothing worse than when you have your W-2 job, you go buy a house, you're thinking you're gonna get $600 a month come in, and then the first bill you get is $8,000 because somebody stole the AC units and the dishwasher and the electric out of
yeah,
your house.
yeah,
And you're like, holy crap, like I didn't make any money off this property and I'm W-2 and I'm supposed to make money on this thing, and I just gotta pay $8,000. And it's tough, man.
yeah.
It's a tough pill to swallow.
Yeah, and
When
if you have those low cash flow numbers like 600, two, three, $500 a month, it is crazy how quickly that money can just vanish. One small thing that you need to repair can completely eliminate all of your cash flow. And this, I found this applies to even to not only single family, but also small multi. I bought small self storage facilities that were 40 units, and that in self storage world, that's a really small facility. And that
Yep.
kind of facility, if something goes wrong, and you have to do a repair, you have to replace a door or anything like that, it'll eat up your cash flow very quickly. Which is another reason why I always suggest people when they get started on the commercial side to look for bigger properties, things that they feel is a little out of their reach, because cash flow does save you in those situations. Which kind of leads me to my next question. You've mentioned single family up to this point. You said at one point you did invest in multifamily, but you've gone back to single family. So you're focused in on single. Why is it that single family is your bread and butter? Most of the time people, once they get into single family, they tend to find their way to multifamily and then stay there. Why did you go back to single?
Yeah, Gabe, I have PTSD. I lost my life savings on that 100 unit I was telling you about.
Mm-hmm.
And even though I was a passive investor, not only did I lose my life savings, but I actually personally signed for the note. And here's
Oof.
another rule of thumb. No matter how many people you hire, an attorney, a mentor, you have a lead partner, you have all these people that are supposed to be in your corner, you still have to read all the documents yourself. And and the next thing is when you're a passive investor, you should not sign personally for anything. If somebody is asking you to personally sign for something, I think you should need to get out of Dodge and not get in that deal. So that was a deal that I did. I had a mentor, I had an attorney, had all this stuff. The deal just was the project. We're trying to take a D property, make it a C property. The problem was that there was two D properties next to our property, so it was going to be really hard to do. And we invested inside, like kitchens, bathrooms, instead of like putting a fence around the damn thing. And so it was a bad plan. The lead investor on that deal, I'm still friends with him today, 20 years later. And we did another deal together. It wasn't all of a loss, but I put in, I had about 120, I was about 31 years old. I had about $130,000 in my 401k, no, my IRA. I moved it to a self-directed IRA. I then invested in this property, and our deal was we were going to take the cash flow from this property and just kind of reinvest it into the property, increase the rents. In 3 years, your NOI goes up, and we sell. Well, the problem was we couldn't get the rents up because we had just terrible people in that area, and we were turning people away. Finally, we had to like settle on and getting some of these folks because we had a vacancy problem, and of course that was a disaster because they take parting gifts when they leave, and then we just had like we were on a house of cards. Anything that went wrong, the partnership didn't have enough money,
Mm.
weren't getting the income we thought we were getting. And we were spending money on new fridges and new tile and all this stuff. And so we had a gas leak and then we had a balcony fall all in like within the same month.
Oh,
So now we have no money. So we call the bank and the bank says, yeah, yeah, we'll work with you guys. Don't pay the mortgage. And 90 days later, they foreclosed on us. They sold the property. We owed about 1.5 million on the property. They sold the property for 2.1 million on the courthouse steps. They already had a buyer lined up. They screwed us. They sold the property, and then there was a clause in the mortgage docs that said even if we sold the property for higher, because normally when they sell the property for higher, they let you go, right? They made their money back. They came after us, and I personally signed for that note. They came after me for 1.5 million dollars. And
wow.
so there was only three partners. One of the partners declared bankruptcy right away. I'm like, I can't declare bankruptcy. Bankruptcy means you're out of the game. Like you still got to protect your credit. I was still working at the time. Like it wasn't like that. Had this business bringing in tons of income. So short story long, we ended up settling for about 30K. I ended up selling about three duplexes, made 30K, and I wrote the check over to the bank. So and then they cleaned my credit up and all that good stuff. They knew what they were doing was just highway robbery. But that one, and I had a 52 unit, really, really low income stuff. And I was a third, like, so there's three lead partners, three passive investors. My mom was a passive investor, and we lost all the rent. We lost all the money. We sold that property for a loss, and I gave my money my mother a fraction of the money that she invested. So I have PTSD. I'm one for three. My 32 unit, I mean 39 unit, we made some money, but for the amount of time and effort I put into it, wasn't worth it. So the moral of that story is, and I was a C property. Again, the moral story is stay away from the low income. They are really hard to manage, and they're hard to increase that rent, get that NOI up, and there's less buyers that I find. And of course, the A and the B stuff are really they're just more expensive. They're harder to get into. So you got to raise more capital to get into those deals, but they're easier to manage. And that is true for single family as well. So I got PTSD. Oh, one out of three. I lost my life savings, lost my mom's savings. So I like single family now. Also, I know a lot of property managers. All my properties in Houston, like I manage properties. I was one of the top property managers probably in the States for a couple of years, and I have somebody else third party manage my properties, even in Houston. I got two properties in Houston I've never been to. I've owned them for 5 years. No reason. I mean, every once in a while, I'm like, I got nothing to do. Let me go drive to, Baytown, 30, 40 miles away, like just go check out my property. Yep, it's there. All right. But there's a few I've never been to. And I like it that way. And, they appreciate, I mean, I got my butt kicked this year with a couple of hurricanes come through Houston. So no cash flow. But as a seasoned investor, I understand there's going to be bad years and good years. So I like single family. I like not. I pay most of my stuff off now, so I think I'm at 12 single family homes, and I think I owe a note on four of them.
Okay, that's good.
And that's another thing that people disagree with me on, and that's cool. Like I get it. Like Kiyosaki talks about leverage everything if you can, but when you see a bank screw you like they did to me, you just decide that I don't want to really play with banks too much.
Yeah.
And so I like paying my stuff down. I'm also older now, right? I was 30 when that happened. I'm 54 now, and so as you get a little bit older, you want to get a little bit more risk adverse, and you want to just like if I had 10, 12, 15 properties paid off, I'm going to be pretty happy, to be quite honest. It's a nice it's a nice cash flow that comes in most years.
Yeah.
Unless Joaquin Barrel comes through every year.
Man, so that's a crazy story. I cannot believe the bank did that. If they already made their money back, they should not be going after you for additional debt. And that is, but that's the lesson in that story is that you cannot take things at face value. You have to look into it yourself, read the documents, get your lawyer to read over documents. Don't sign things that make you personally liable for them. Yeah, great lessons in that. I'm sorry you had to go through it, but now you're on the other side, and you have those lessons in the back pocket for all the deals coming down the pipeline.
That's it.
All
That's
right.
right.
Well, hey man, I love that story. We have run down the clock. This is a 20-minute show, so we got to move it on. And go into the quick question round. Are you ready?
I'm ready for it. Let's do it.
Let's do it. It starts with education. Could be any form, could be a book you read, a conference you've gone to, mentorship program you've been a part of. But I need two recommendations, one for general life wisdom and then one for real estate.
All right, so two recommendations. So real estate, I like. There's a book called Profit First by Michael Michalowicz, and then this guy David Richter wrote a Profit First for real estate investing, and I think that book is really, really is a great book. I was going to go with the Kiyosaki, Rich Dad Poor Dad, but everybody talks about that one, so that's the book for a non-real estate book. I'm a big business guy. This is my second business I started now. So back when I was 30, I didn't know how to run a business, didn't know anything about it. And now, I feel much more confident. And the book that's helped me the most is a book called Traction by Gino Wickman. And he uses the EOS or Entrepreneur Operating System model. And I run both of I ran my first business and I run this business through that book. So those are two books I highly recommend.
That EOS, they have their own like CRM system too. That has been recommended multiple times on this podcast. That's interesting, and it's usually for just not property management, not real estate, but for actual
It's
running a
business,
business.
it's business agnostic. Yeah, you
Yeah,
can run a business on it.
that's cool. All right. Next question is for your younger self. Let's go back to the Pete who was just buying that first property so many years ago. Go back to him, look him in the eye, give him one piece of advice moving forward.
One piece of advice moving forward. Well, I probably said it when we are talking, in our first part is don't just focus on one aspect. Don't just focus on cash flow. If I really would have listened to that, I would have bought different properties and I would have gotten to the same result. I would have still, I exited, Empire, my property management firm, and I made millions. I would have got there, but it would have been a hell of a lot easier.
All right, good lesson. Next question is about the US. It's a big place. There is a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
Yeah, I said it earlier, Tulsa. I really think so. The old saying is when should you invest in real estate? And the first answer is 20 years ago, and the second answer is right now. Knowing what I know about Houston, I think Tulsa is Houston 20 years ago.
Hmm.
So I think for a single family anyway, I think Tulsa is the hot happening spot, and then second is Indianapolis. Indianapolis, you're not going to get the appreciation that you're going to get in Tulsa, but you'll get cash flow.
Yeah. We own an Indy. I have not, I ask this to every single person that comes on this podcast, your episode like 500 something. But I don't think anybody's recommended Tulsa before. Why are you so bullish on Tulsa?
Well, for one, you can buy properties there for about 120,000. Two, you get the rent. It's the 1% rule, which you cannot find in Houston. That was the main driver on why everybody loved Houston for many years. Houston was a hotbed for real estate investing. No, three is they get some tornadoes, but not very rarely in Tulsa. So you don't have the hurricanes. Property taxes are super low, and insurance is not very expensive either. So not only do you get the 1% rule, but now you have low insurance and low taxes, and it's a growing metro. And Oklahoma is a red state, so they have good property owner rights. And I truly believe in 20 years these houses will double or triple in value.
All right, there you go. That leads us to the next question. This is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. So, what is your favorite way to generate leads and find new deals?
I like my property managers. I honestly do. Like I don't even go out. I don't even look for deals anymore. My property managers come to me, and if they have a good deal and they think it's a really good deal, and I'll look at it. I have a little spreadsheet that I've used for years, and I plug in the numbers, and if it looks good, I buy it.
Easy enough. We're going to put that in the bucket of relationships. We've said that so many times on the podcast. Real estate is all about relationships. And so property managers are one of the people. Make those relationships, and it will develop your career, and it will be a two-way road. You'll help them getting them properties. They'll help you getting you properties. So yeah, relationships are everything in real estate. Brings us to the next question. And this is about uh, lessons learned. Not every deal we go into goes the way we expect it. Many times things go a little sideways. So, what was a deal? You've already mentioned one. That was a really good one. So, I'm going to say a different deal. What was a deal that went a little sideways for you? And then what was the lesson you pulled from it?
Yeah, well, when I bought all those low income properties, I would say that the lesson learned again is don't buy just on cash flow only. Also, the lesson I'd learned was that I just assumed that okay, you have some make ready costs, right? And make ready costs are usually a couple of $100, maybe $1,000 in single family. Well, when you buy low income, those make ready costs are like $6,000 because people in low income areas, one, they don't really care about their credit, and two, they don't really care about the lease, and three, they don't care if you file eviction or collections on them. They just don't care. They're vagabonds. They just move from one house to another, and they take parting gifts with them. And so I mentioned this before, but they take my ACs, my stove, my fridge. They leave holes in the walls. There's dog feces everywhere. They take the electric, and next to every door. I don't understand it, but they must beat up the doors just for the hell of it. Every door is broken,
I
and so what you
laugh
think
because
is
that
just
reminds me of when I first got into real estate. I bought some duplexes in low income areas, and I remember flipping this one unit. Somebody was stopped paying rent, so we kicked him out. And when I walked into that unit, there were holes everywhere, and I was like, "Why are there so many holes in these doors? Like, what were you guys doing?"
Yeah, I
It's
think they must beat each other up, and then also like they get pissed off, right? So they deliberately leave holes all along your sheetrock. I've seen that. So it just you just don't realize it. You think, okay, I'm going to put in 20% or 10% for loss of income, for evictions. But you never have to put in 140% for damage. And then of course the insurance doesn't cover it, or they say it's not really damage. It's just the insurance company just never covered it. So you end up covering yourself. So that was lessons learned. So low income, they're going to damage your property.
Yep. All right, that leads us to the last couple of questions here. You've been a great guest. You've given us a lot of wisdom. I'm sure people want to reach out, get in contact with you. So this is kind of a two-parter. First, tell people how can they find you, and then tell people a little bit about VPN Solutions, what you guys are doing there, and what can they expect when they reach out.
Yeah, so you can find me on LinkedIn, but I'm kind of old school and I still run my own email box. So pete@vpnsolutions.com is the best way to get me. If you, I own VPN Solutions is a platform that connects the real estate industry with virtual assistants. So, if you're an investor and you just don't have time because you're working full time and you need somebody to do like appointment setting or transaction coordination or SEO or just daily things that you just can't get to, you can get on our site, find some people, hire them through our platform, pay them through the platform, and then you can actually have a part-time or a full-time person. We have a do-it-yourself model, we have a do-it-with-you model, we have a do-it-for-you model. The do-it-for-you model is $1,500. The do-it-yourself and the do-it-with-you model are free. And if anybody wants to email me and they put the Real Estate Investment Club in the subject, I will connect you with our Gold Glove and I'll give you 50% discount for
Perfect.
listeners.
I love it, and I will say having a virtual assistant on your team as one of your first hires is a lot of people will say I don't have enough cash flow yet. I need more money, but I'm telling you, get an assistant before you think you need one, because it will take off so many of the small time sucks that you don't really realize you're doing, and time is the ultimate currency here. So it's definitely worth it. Reach out if you guys don't have a virtual team yet. Um, so that wraps it up. Pete, thank you very much for hopping on the show.
Gabe, appreciate you having me. Thanks, buddy.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at the realestateinvestingclub.com. If you guys want to support the show, just leave us a review. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.